Hello, I'm Imogen Bakra and welcome to The Year Ahead, a podcast series where we explore the big themes and events shaping 2025. In this episode, which was recorded in front of a live audience at our Year Ahead customer event in London, our specialists take a closer look at how the direction of fiscal policy has shifted in the wake of huge elections worldwide, and they discuss the impact on FX and fixed income markets against a backdrop of the race towards terminal rates.
Well, our first panel today has been titled Local Ballots, Global Impacts, How Will Elections Reshape Policy? Sort of subtitle, Life Comes At You Pretty Fast Sometimes. And we will be talking about some of those things that Imogen has mentioned, going into some more depth on that. So who is going to be talking about that? Well, on the end, we have Ross Walker, the Chief UK Economist, Markets. Next to him, Paul Robson, Head of FX Strategy. Joann Spadigam, European Bond Rate Strategist, and Philippe Bradshaw, Head of European Syndicate. And we will be talking about the state of the major economies. We will be talking about how elections have influenced policy and monetary policy in particular, and what's going to happen in monetary policy. Ross, it falls to you to sort of start our engines here. They get us going. How would you characterize this economic outlook that, with especially what you've been saying about global growth and this story of economies diverging in 2025?
Yeah, I think the positive is the global economy has come through a once in a lifetime, maybe a once in a century shock in the pandemic in better shape than many feared. Certainly, if you look at labour markets, there was far less scarring than was feared during the early phases of that crisis. But of course, as Imogen was mentioning in the introduction, there's been a huge fiscal cost and burden built up. So we find ourselves in growth terms. The global economy has been, I think, remarkably resilient, but there's also a lack of dynamism, particularly, I think, in Europe, but also increasingly in parts of Asia as well. The US, in that sense, looks more exceptional. I think it probably does in many ways look more exceptional post the election of Donald Trump. So growth terms, we're looking at global growth being a tad weaker than over the past year or two, but 2.5%, 2.75%, not terrible, but materially lower than in previous cycles. And I think part of that is the deglobalization theme. We actually, interestingly, just in terms of the trade data, which had faltered very badly despite a generalized recovery, just in the last couple of months, we'd begun to see some tentative signs of recovery there. And of course, then you have this huge overbearing risk of increased US tariffs. So that is clearly one of the huge headwinds, particularly for the UK, to some extent the US. Fiscal positions look extremely stretched, and that is not going to change. And we're in a unique position, I think, again, just in the UK context. We've never before had this combination of such high debt levels relative to GDP, very high expected continuing deficits, but also now funding costs which are dramatically higher. 10-year gilt yields a percentage point or so above nominal GDP growth now, and of course no central bank QE to mop up all this supply. So that confluence fiscally is clearly going to be a drag ultimately. Certainly on private sector growth, you'll have this sugar rush. The UK budget, Trump tax cut extensions, rollovers will provide some near-term support, but medium-term, I think there are some big risks in terms of the private sector being crowded out by these sustained higher borrowing costs.
And Imogen made me feel very old when she talked about terminal rates settling at much higher levels than we've seen in the past. Thanks. Tell me, the levels and the timing, give us more detail about that.
So we've had a lot of market movement around terminal rates, obviously with the UK budget, the US election, this fiscal theme, which I think was much neglected, I think is now very much in the market's crosshairs. So we see terminal rates, again, as mentioned earlier, 4% in the UK and the US, 2% in the euro area. I guess maybe relative to current market pricing, we see the risk that terminal is reached a bit sooner. So by the middle of 2025 rather than later in the year. I guess the risks we would concede the risks are tilted towards a slightly later delivery. But I think central banks, the VOE, the Fed, there does seem to be a window in the early part of the coming year, subject to a disciplined wage setting season, where some earlier cuts, sustained cuts could be delivered. Terminal is interesting. We've got a 4% nominal terminal bank rate. So if inflation's at 2%, a 2% real rate, that sounds dramatically high, as you say, to people of a certain younger generation. But, some of us have been around a bit longer. And, if you think back to the great moderation, that decade up to the financial crisis, nominal policy rates in the UK essentially ranged between 4 and 6%. So we're only talking about our forecast, a nominal bank rate of 4%. That's essentially at the lower end of that previous pre-ZERP era range. And it wasn't that long ago. And you also had some more favorable global disinflationary trends as well, which allowed Western economies' policy rates to be a little bit lower than they otherwise would. So to me, a sort of 4% nominal rate actually doesn't seem that outlandish. Now, the fact that if we were sitting here this time last year, markets were pricing in over 160 basis points of Bank of England policy rate cuts by the end of 2024, and we've had 50. I think there's still a sort of an intellectual reset going on, but I'm not sure why there's such skepticism that terminal rates would need to be a bit higher, given this significant fiscal shift we've seen in the case of the UK, some of the supply side impairments, reduced labour supply, depleted capital stock, and so on.
And you are confident that the UK is going to come in at about the same as the US on terminal rates?
Confident? I think similar sort of territory, but I think for different reasons. Demand is materially stronger in the US. And, whatever your view of Donald Trump, I mean, there is a clear pro-business, pro-competition, maybe you could debate, but pro-business, pro-growth agenda. And through tax cuts, through deregulation, this is not a risk-free approach. But I think you can understand why risk appetite has responded in the way that it has. The UK, I think, is, as I say, slightly different. Demand is a bit more middling. I think it's surprising we generated the inflation we have, and it's as sticky and persistent as it's been with those levels of demand. And as I say, I think it alludes to the supply side impairments in the UK economy post-Brexit, post-pandemic, and it's just taking longer for those to work through.
And in the last few years, of course, many countries have been running extraordinary deficits. Do you see that continuing through 2025, or will we start to see consolidation?
Well, for me, fiscal policy is always primarily set on a political cycle rather than an economic demand management one. And in the US and the UK, we've just had elections this year. I'm surprised by the extent to which UK fiscal policy has been loosened this early in a 5-year parliament by a government with a large working majority, and with limited fiscal headroom, even once the fiscal goalposts have been widened by £22 billion. So as you move through the parliament and that next election comes closer, and it might be a 4-year term, it might be a 5-year term, the political pressures are not going to be pushing towards consolidation. But at the same time, we've seen there's been a big gilt market reaction, sizable gilt market reaction since the UK budget, and I think a warning shot to governments about the limits to which fiscal policy can be pushed.
Thank you very much. So let's dig into that in your particular areas. Paul, first of all, as we saw in 2024, relative rates, big driver of FX. Is that going to carry on?
Yeah, I think it is set to. I think it's going to be the sort of primary lead character in the drama that can often be FX markets. There will be other supporting characters in this. So, for example, domestic demand growth across the major economies. Interest rates are coming down. Economies are responding to that. Equity money will flow into those economies. I think that's really quite an interesting theme. Risk appetite, equity market performance across the major economies, that will also drive currencies. Risk appetite, geopolitical tensions in the Middle East, these are all going to matter. But relative yields, I think, will be the key driver. But, and there's always a but, Ross was teasing me earlier in the week when he said we only have FX strategists to make government labour market statisticians look good. I think he was teasing. But so there's always a but, and that but is what Imogen was talking about, that it's the terminal rate, the landing point, that's going to be the main driver of currencies, rather than the pace and sequencing of rate moves by the central banks. If you look at euro, dollar and cable this year, they pretty much mapped where markets thought the Bank of England, ECB and the Fed would end this year. And that was very important, and that ebbed and flowed, and therefore the currencies also ebbed and flowed. But I think when we look to the future, it's going to be about, I struggle a little bit with the year ahead. I keep coming back to this idea of a war on inflation. Okay, the war on inflation is almost over, but what does the peace look like after that? Again, I was just listening to Remembrance Sunday a couple of weeks ago, and I was struck by like an artillery barrage. And once the guns fall silent and the smoke clears and the dust settles, what are you left with? And as Ross said, and Imogen said, we're left with sharply higher fiscal deficits, but we're left with sharply different terminal rates across the major economies. And so that but, I think, is that the change in FX rates in 2025 will be more of a function of the level of rates rather than the change of rates. And I think that's a very important detail. But as I say, there's going to be lots of other drivers that will ultimately make sure that I'm wrong.
So just to give you a few other things to be wrong about, perhaps, all right, everyone in the room wants you to say what's going to outperform, what's going to underperform next year.
Where terminal rates going to be the highest? Well, they're going to be the highest in the UK, US, and for some time, Australia, maybe Norway for a little bit. And I'm really struck by euro sterling. I think euro sterling is going to be fascinating in 2025 because I think we are on this sort of post-Brexit price discovery. You know, we've been at these lows a couple of times since Brexit. And every time we sort of test lower, we ran into something else like COVID or the European energy crisis. But, you know, we've gone through that. We're testing the lows again. And the UK is going to have 4% rates, terminal rates. Euro area 2, maybe below. Other central banks like S&B near to 0. Sweden's going to be cutting rates. I think there's a nuanced story there. But I think those are the three that are going to outperform. And, you know, sterling outperformed last year on relative rates, and I think it's set to do that again.
Underperforms?
Well, it gets a bit difficult. I'm sure another but's coming along here in a minute. But, you know, New Zealand, you know, cutting rates aggressively. I actually think Norwegian krona actually underperforms quite significantly. I think people have got that wrong. One of the key views that we have is a lower oil price. I think that matters as well. I really struggle to see the euro performing well in 2025. I think the thing that stops the euro from going to parity is the current account surplus, I think. But growth looks really challenging. Europe squeezed between the US and China, and weak politics in Europe, I think, is going to live with us throughout next year. And you think about the UK, and we've got a little bit of political stability. For now, at least, Ross. I did note that you mentioned 4 years, not 5 years. So I'm a little bit worried about that.
Thanks very much. Joann, We are all concerned about the inflationary impacts of fiscal policy. Are markets underestimating them, in your opinion, though?
Well, I mean, I think the other thing that I suppose characterizes this year is the US data and how strong that has been. I think a lot of us here would have been burned to some extent just by how resilient the US has been. And of course, there are many, many good reasons for that. But one of the things clearly playing a part here is fiscal policy and how expansionary that has been. Obviously, we've had a few crises, COVID, the energy crisis, and governments as a result have had to spend quite a lot. But I think, since then, we've seen a normalization, I would say, in economic conditions to some extent, whilst fiscal policy has remained fairly expansionary. So I think that clearly has an impact that will clearly have an inflationary impact going forward. For the market, I think the more recent events, so the UK budget as well as the US election, has brought that to the fore a bit more. So clearly the UK, where there's going to be higher spending, but also spending on things like public sector wage, that does have an impact on the inflationary outcome for the UK. In the US, there's clearly lots of uncertainty about what tariffs will look like. But what's also clear there is that there will be tax cuts, which means that spending there will also be significantly higher. So I don't think we can really be, I do think that markets are becoming more and more aware of these risks and are pricing them in. But I think clearly the risks to inflation are to the upside based on the trajectory of fiscal policy for next year. In the euro area, I think things are a little bit different. I think, the European EDP process and European fiscal rules does help to keep some countries more on track. They might have been a bit more, I suppose, physically spending, wanting to spend more physically. So the rules have kept them a bit more in check, I think. I think what's interesting to me is if you look at countries like Germany, the way in which they approach debt and how, I suppose, conservative they are with debt probably does come to the detriment of growth in Europe. So I think there's a bit of this divergence again in fiscal policy and what it means for inflation between the UK, the US and the euro area as well.
There's a huge amount of supply now, and presumably in 2025 as well, that's going to carry on. Are you worried the markets will not be able to digest all of that?
Yeah, so I think supply is one of our favorite topics, to be honest. It's something we've talked about a lot this year, and I think will be something we talk about a lot next year as well. I think over this year, the market has been quite obsessed, I would say, with where terminal rates will land, what level that will be at, what kind of pace we'll be taking those rates down at. And I think that with most major central banks, so I'm thinking about the US, the UK and the euro area here, really finishing their cutting cycles as per our estimates in the first half of next year, the markets will really have more time, I would say, to worry about the second most important theme, which is fiscal policy and supply. I think it's important to note that this supply story is not really a local theme. It's not a domestic theme. It's a fairly significant story across the UK, the US and the euro area. So there's quite a big global supply theme that I think needs to be priced into the market and really that the market needs to be aware of and price the risks accordingly. So I do think with the focus really moving away from the front end of the curve and my personal pet peeve, everyone's obsession with Fed policymaking, really the focus will move into supply. This year's supply was fairly well absorbed. There's been foreigners stepping in to buy, who in my mind are not the most reliable sources of demand. There's been retail investment as well, which I think is again more front end focused. And there's been some bank demand as well in certain countries. But I think what's important to note is for the back end of the curve, the pension fund story is clearly moving quite significantly, both in the UK and the euro area. And clearly the central bank story of QE has also ended. So I think as Imogen alluded to, that to me suggests that the global story for fixed income will just be steeper curves over next year. Clearly it's a consensus trade. I think it's fairly consensus for a reason. I think it's quite evident that supply will become a key concern over next year.
Do you hold on, Joann, because I want to ask you about underperformance. It's not fair if I don't ask you as well. For Philippe, how do you think issuers are going to cope with this glut of supply?
I think that it's fair to say that they're not happy with the current situation, but I think that when you looked and bouncing back on Ross' comment earlier on kind of what we used to see before the financial crisis 2008, we had similar yields level for credit, either for FI and corporates, and that was working quite well. It was like it's all a question of internal return that these companies have to face, and right now there's no stress on that. I think the big elephant in the room, which is maybe for late 2025, if inflation is coming back because of tariff. But right now, with the stress is, I would say, very limited for the credit side. On the agency side, which are looking more on a kind of credit spread basis, it's clear that with all the expected supply, swap spreads tend to be tighter and impacting, therefore, valuations. That is a bit harder to swallow. But bouncing back also on the comments that we were talking about the level of in the capacity of the market to absorb the supply, we have also to take a step back and looked about the fact that we are coming into a form of normalization with these kind of rates that use kind of normal rates 20 years ago, where a large wave of retail investors think now about the fixed income as a relevant product, and maybe at the expense of some other asset classes. But the feedback that we've been getting from investors over the past 2 years was massive inflows of cash for funds and fixed income funds. And therefore, all the supply that we have seen, for example, on an FI front or corporates, has been well absorbed this year without being impacting the spread. It's more like the kind of all-in yield levels that have been impacted because of the government bond supply. But we still remain quite constructive for 25 because of these large reallocations of money.
You're not concerned that we will exhaust investor appetite for fixed income?
I think there's a price. And then right now, as long as the terminal rates perceptions remain where they are, investors will be happy to just step in further into the fixed income assets. I sense that reassessment will have to be made maybe late 2025 if we start to feel like the Trump administration is able to implement tariff.
Okay, Joann, back to you for underperformance. You've had time to think about it.
So, I mean, I suppose anyone that's really talked to Imogen or Ross this year will know that we've been very bearish gilt for most of this year. I think that we do think that trend does continue into Q1 as well. While the supply story, again, I think is most important in this regard. Another fun fact on supply. So if you look at the pre-COVID average for the few years before pre-COVID, in terms of the supply we had then, and look at what supply we have upcoming, it's 7 times larger in the UK and only 2 times larger in the US. Obviously, the amount of US treasuries in total is larger in terms of supply, but in terms of the actual impact versus the size of the market, it's clearly much more prevalent in the UK. So we are seeing that gilts will continue to be the underperformer into the start of next year. I think in terms of Europe, it's been an interesting one because I think Europe has really been the favorite long over this year. The data has been quite divergent, I would say, between the euro area and the US, where really euro area data hasn't really surprised too much to the upside or the downside. So I think the cutting path is more clear for Europe, for example, and risks of the upside in inflation are much more muted. So I think that doesn't mean that the euro area will remain everyone's favorite long and will be most likely to outperform as well as a result into next year.
Philippe, you've got to make your predictions as well. Sectors in credit, outperforming, underperforming.
So, in 24, we have seen a few sectors which were having like high beta characteristic performing very well. So, like on the FI side, 81s, tier 2. We have seen a solid performance on corporate hybrids as well in some sectors such as retail and real estate. Now, looking in 2025, I would say that things are going to be a bit more nuanced in a way that is going to be more or less as a sector, but name. And the non-cyclical names are the ones which are going to be the preference. There's also a preference for national champions, either on FI side, but also in kind of large, well-established corporate names, where clearly the investors who are buy and hold by nature are going to think more about what's going to happen in case of we have like some form of the soft landing or even small recession because of the tariff and so on, as kind of 2 or 3 years time perspective. And therefore, these sectors are going to be scrutinized. The other sector, which I think we'll have to find the right balance between the cash inflows and it's more like agencies, and also the ones running fixed income funds with a lot of government bonds. I think these ones, it's all going to be again what we were talking earlier on about their views on terminal rates. Currently, with the kind of repricing that we have seen post US elections, we sense that investors are quite happy to step in for the time being, as long as the inflation is still under control. So that's overall, I would say that no one is facing massive concerns for the early 2025. But the outperformance that and I think the timing of the investment in 25 are going to be even more important to generate some alpha.
Okay, we've got a few minutes left, so I want to play a game with you guys and on your faces. So imagine that we're sitting here this time next year. What are you most likely to say to me? Oh, that was wide of the mark, what we said at the end of 2024, and why has it been wide of the mark? Ross?
We never rehearsed this bit, did we?
No, not at all, no.
I mean, I think in the macroeconomic side, I think the big question is, for me, is still about domestically generated inflation or services inflation. Maybe less so in the euro area, more in the UK and the US. The lags have played out much more slowly so far. I mean, we had CPI data in the UK today. Interestingly, a month ago, we had a much bigger than expected fall in services inflation. That triggers a sort of media narrative, sort of market sentiment about, right, here we go. We've got disinflation is coming. And then today you get a higher than expected number and, everybody begins to get the angst about whether, we can get further rate cuts. So for me, it's about services inflation, and that in turn, we won't need to wait, at least I think, until the end of the year. I think when we get through by the spring, we'll have seen how the latest sort of wage round has played out. We've got minimum wage pressures at the bottom end, big public sector inflationary pay settlements. I don't think that process has run its course. And then, of course, against that, national insurance tax rises for the private sector, which will presumably have a dampening effect. So some big moving parts, but I think what could really move, and if, terminal rates are going to end up in the US and the UK closer to 3 than 4, you will need to see much more domestic disinflation, and the channel for that will be through the labour market.
Okay. Philippe, I'm going to come to you out of order.
Okay. I do recall 1 year ago when we were talking about credit spreads, many investors were saying the rally is already over for 23. We are not going to see any form of performance in 24. And here we go. We have one of the best year for that. I sense that there's a lot of noise related to the Trump administration, and the key point is going to be his ability to implement a tariff. But we could be in a situation whilst even US right now, we see the tightest spread over the past 25 years. We could still see, and thanks to the US economy, some reverberations also for the UK and for Europe, and see further performance into credit spread for 25.
Okay, Joann.
It's like a pop quiz. So I think for me as a European rate strategist, one of the things that we've been talking about quite a lot is a 2% terminal rate, and that being something we have reasonably high confidence in. And that's really based on the fact that we think that European growth will improve next year based on this private consumption story. And to me, I think that will be an interesting one to watch. I mean, I think the ECB minutes as well did show that some of them were a bit concerned about whether we would see that consumption-based recovery and growth. So I think, to me, that's a big risk for next year. Where will terminal rates in Europe eventually land if that consumption recovery doesn't come back to play?
Thank you. And Paul, finish us off.
Yeah, where I might be wrong this time next year, and it will be, I think, on the UK bond market, influencing sterling's risk premium. I think anyone who, again, has listened to Ross or Imogen knows that we're particularly negative on gilts. Every time I listen to him, I have to go home and have a double gin and tonic. We do a lot of breakfast presentations, so that becomes a bit of an issue, having a gin and tonic at before lunchtime. But we are on a little bit of a sweet spot here in terms of fiscal policy. Fiscal policy is in just enough of a bad place to keep the Bank of England cautious, keeping rates at 4%. We think that's the key theme. But there is a tipping point, and we've seen that previously in sterling. So I think for me, where I could be wrong is we step over that. The UK bond market has a particularly bad year, and sterling is sharply weaker because it's the liquid asset that people can hedge their UK portfolios. You can just phone up NatWest and sell lots of sterling if you're worried about the UK economy. So that keeps me up at night.
Okay, thank you very much. Our time is up here, so you can, of course, ask more questions to anyone in the panel. The advice was to wait until they've had a drink. My advice as a journalist is to wait until after they've had 2 drinks. It always worked for me. If you would just like to thank the panel, and I'll hand back over to Imogen.
Thank you for listening. If you like what you heard today, please make sure to like and subscribe to our channel and navigate to natwest.com/year ahead for more insight into the big themes and events shaping markets and the economy in 2025.